Hello, everyone. This is Brittany Button, long-term care insurance specialist for Art Jetter and Company. Today, we have two guests joining us for our March 1st Friday session. I'd like to welcome Advanced Sales Consultant Ryan Patton and Rob Johnson, Sales Vice President with Lincoln Financial. Today, we want to show you how a Section 162 executive bonus using Lincoln MoneyGuard can help employers retain and reward their employees. We'll also have a quick review of their pricing improvements and key features of the MoneyGuard Fixed Advantage solution. Before we get started, there are a few handouts available for you to download, so please make sure to take a moment to do so. Also, at the end of this session, we will answer any questions you may have. So just type those into the questions or chat box, as I'll be keeping an eye on those. So Ryan and Rob, let's get started.
Great. Thanks, Brittany, and thanks everybody for joining us today. Excited to be here and chat with the team on this 162 bonus using that long-term care concept. So, Rob, if you would, we can jump into the slides here. So the first thing that I always think is a good way to start things off is, why is this a topic? Why is this a hot topic? And generally the way that I approach this is really focused on those closely held business owners. And just to give you a frame of reference for that, most recent statistic that I've seen is actually that we're at a little over 32 million closely held businesses in the US. And oddly enough, that represents nearly 100% of the businesses out there. That small percentage, even though it represents about 53% of the actual employment, everything else is actually small businesses. So those big companies out there, not necessarily the marketplace from a business perspective, it's the closely held businesses that are really making up a lot of our discussion today. And the reason I love this market, this closely held business market, is, and it's specifically related to this topic we're going to cover, is when you talk to the value of those businesses, when you're speaking to the owners, a lot of the value of that business isn't necessarily the widget that they sell into the market. It's the services and the relationships that those key executives, along with the business owner, but those key executives drive every single day. I go to my dentist, not just because of the dentist, but because of the hygienists that I know. It's those skilled professions, those unique traits that they have that really drive the value of the business. So what we're going to talk through today is really how to retain those key individuals, to make sure that those business owners, the closely held business owner marketplace, that they secure the value that they've grown. And as you can see on the screen here too, there's some really unique and just fascinating stats out there. The women-owned business, that's also grown. We're certainly above the 12.3 million. Very unique niche as well. A couple of the other stats on there just go to reaffirm, that this is a growing market. You can probably step foot on your road somewhere and find a closely held business that would be worth having this discussion with. So with that, Rob, we can jump into the next slide. So from a 162 bonus perspective, who should I be targeting? This isn't a all-inclusive section of who or why, but these are generally the topics that I like to see brought up when I'm going to have this discussion with a business owner. A big one, and maybe this is for right now to some degree, but also for the end of the year, is folks are generally looking for some sort of deduction. Business owners are notorious for not wanting to pay taxes. Who is really? But our business owners, if I can get a tax deduction and add value to my business by retaining those folks, count me in. The other nice thing about this too is this type of setup is easy. It doesn't require any additional forms to some degree. There's no real administration every year that we have to do. Really what we're focusing on is giving a bonus, some sort of wage to that key employee, and we're getting a business write-off for it. So those additional wages, we can write those off as wages. So very nice, very flexible from that regard. I would say the folks to look for as well from an employee perspective, and why this is such a powerful tool, is we don't have to offer this to everybody. And if you think about those closely held businesses, it's not necessarily that every single employee is really driving the success of the business. They certainly offer value to the business, but think of those folks that, you would say to the business owner, gosh, what would you do without, X person? How much would the business lose in revenue if they weren't here? This is the type of arrangement we're looking for those key individuals. Not everybody, like a qualified plan would be. It's very selective, very targeted, and we can be completely discretionary too. So very, very nice from that factor. The why that we would do this as well is, I want folks to stay. Say I'm a business owner and I want to transition out of my business in the next 5 years. A future buyer of the business is going to be apt to pay me probably a little bit more if they know that the certain management structure I have in place today is incentivized to stay through that transition. They're going to be purchasing that cash flow of the business, so they want to have that consistency there for that cash flow. And a great way to do that is the executive bonus arrangement. We kind of covered a few of the other things as well, the tax deductibility. We'll dive into that in a second here. But the thing I love about this conversation is a lot of folks will say a bonus is great, life insurance as a bonus is great, but if you want to talk about a unique bonus to offer, is that long-term care, almost like an executive benefit as opposed to a bonus. So with that, Rob, we can jump to the next slide on how it works. This is it, folks. So we talked about it being a little simplistic. Yeah, this is all there is to it. So from an employer perspective, instead of giving that extra, say, $10,000 directly to the employer or to the employee, we're going to route that money into a life insurance product to give them that extra benefit, that extra, living benefit that employee is going to receive. There's really two ways to do this. I can either give that bonus and say it's $10,000. I can say, employee, great, you're getting a bonus. There's a little bit of tax just because of your tax rates. Cover that on your own because I'm already forking out the 10,000. Or we can do what we call a double bonus, and that would be I'm giving you the 10,000, but in cash I'm going to give you a little extra, say $25,000, $3,000, just to cover the taxes on that bonus. So that, that's about it. Pretty straightforward from the employment side. And then during retirement or at death, that policy is going to be owned by the employee. So from an employer's perspective, not a lot of direct control. There's certain ways to restrict this to say, stay with me for the 5 years. Otherwise, you're going to have to pay me back what I paid you. But in general, if we want to just give it out that executive bonus, it's theirs. We've written the check, it's in their control. They can list their own beneficiaries. They can take the funds as they seem fit. So a lot of flexibility and a lot of control for the employee too. So with that, Rob, let's jump into a kind of case scenario. This is a scenario that I see very frequently. We've got Tim and Kevin. Tim owns a business, a closely held family business, and he's got a skilled executive here, a plant manager, Kevin, who's 55. Tim sees him as kind of that, next guy. He's the one that's really making the business happen for him. So, from Kevin's, perspective, he's got a lot of value. What happens to the business if he were to leave? He's got specific knowledge. He has, that it would be valuable to a competitor. He's got certain skills that have been developed and honed in with Tim and his closely held business over the years. That's a lot to replace. It's a lot to replace. It's a lot to, retrain those individuals. So that makes Kevin somebody that's very, very important, and we want to target them specifically for this type of planning. So with that, let's jump into a couple different scenarios we could walk through. First one I want to touch on is just the MoneyGuard Fixed Advantage. The nice thing with this design is it's guaranteed. You can see that in the first box here. It's a nice, I want to provide a bonus. I want to make sure that their family is well covered and well taken care of. This product is really designed for that. We want to have this, ensured that that individual, if they go through this, if Kevin goes through something in his lifetime, we've added that benefit to his family. It still has some flexibility as far as, I can take the funds if I do have that event. I don't have that elimination period as other products and other carriers might have. It's mine when I need it the most. And the nice thing with this type of benefit planning, as opposed to say just a straight cash or even putting it into say a life insurance product, is this benefit is really there to protect the other benefits that you've already given to that employee. So you've been giving him raises, you've been giving him all these other things through life. This helps to secure what you've already provided. So we're not going to lose assets to the long-term care bogey that's going to happen. Could happen, which majority of folks actually do have that long-term care event happen. So we're protecting really that legacy that individual, Kevin here, has built with us over the past 20, 30 years. So with that, let's jump to the next slide here and see what it looks like. So if we give to Kevin $10,000 for 10 years until say he retires, here's what it looks like. So on the left side, on the employer side, you can see that we get a nice deduction for certain extra payments that we're giving out. So we have a nice 35% deduction we're able to take each year when we make this payment to Kevin's policy. And on the right side, here's what it looks like from Kevin's perspective. We're receiving this bonus. We have a little bit of tax that we have to pay on our own. But the nice thing is, even the cash value in this policy year one is more than the tax I received. So if something, heaven forbid, happens and I have to surrender to this policy, I've got $7,000 of cash value in the policy year one. So, I don't have to worry about that tax hit necessarily. And heaven forbid something happens to me, I've still got that nice death benefit over there as well. So very, very powerful. The nice thing about this from a long-term care perspective is year one, I have a monthly benefit with this policy, $4,300. So not bad. If we go out all the way till year 10, when we're in that retirement kind of window, I'd be looking at about $5,600 of monthly care that I'd be eligible to pull from this policy. So very strong, very nice that it's a guaranteed product as well. So again, focus on that legacy that we're trying to protect and preserve for that key employee. The other option I wanted to run through with you is the market advantage. So this is a little bit different. This one has a little bit more growth potential, so it's not necessarily that guaranteed product. Same flexibility, same sort of care that we can offer. Stay home, we'll provide you some care as well. Same focus from a legacy perspective, but let's look at the numbers a little bit on this one too. So same thing from an employer perspective, we're still getting that same deduction because we're giving out that $10,000. But on the right side, you'll see the cash values are a little different, but the death benefit's actually a little bit more. So we've got a little higher death benefit potential, but the real focus here would be that long-term care. So with this product, we would be looking at year one long-term care values for that employee, for Kevin, of $5,700. And year 10, assuming everything kind of goes to plan, we would have about $8,000 of long-term care benefit. So I know that this discussion is going to be, based on each individual's kind of market feel, their tolerance to risk, but know that you've kind of got both scenarios out there to plan for. So if you have somebody that's exposed to the market, great, let them have the market advantage. Or if they want to have that more, comfort, the guarantee that it's going to be there, we've got that fixed, ready to go for you too. So I wanted to wrap out my time here before I hand it over to Rob with, who should I look to? And I've got two very, very quick for you. I would say the biggest one always to focus on with this discussion is who in my business helps me make the most revenue from a, kind of an ongoing consistency perspective. Which one of these individuals or groups of individuals should I really target? Because this doesn't have to be for everybody. So whenever you're thinking of this conversation, think of the folks that are really impacting revenue for the business owner. And I'll give you one great example that also has kind of a tax play to it as well. This past year, I had a dental practice, kind of tying into my initial discussion. I had a dental practice, and they were right at the threshold. If you're aware of a tax code out there, it's called 199A. That's that elusive 20% deduction I can get from being a pass-through business owner. So with that, for specific businesses, those more skills-based businesses, if I hit a certain amount of income, I'm actually not eligible for any of that 20%. So with that, why wouldn't I look to maybe see if I can qualify, bring my income down a little bit, but qualify for that deduction by giving a bonus to some of those skilled folks? So the one that I had was right at, say, 415 of income. We chose to do a $10,000 bonus to one of their dental hygienists. That bonus made them eligible for the 199A as well. So that true cost of the bonus to them was actually a lot less than the 10,000. So if you're looking for kind of a pocket, look to those skilled professionals, because there's certainly a lot of value with those key employees that they have, and they might be able to get a few extra deductions by doing some sort of planning for their key employees as well. So with that, I've done a lot of talking. Rob, I'll kick it to you to give them some good insights as well.
Great. Thank you so much, Ryan. Really appreciate that insight and, first of all, your experience with this. So let me move forward. So MoneyGuard, Fixed MoneyGuard, MoneyGuard Fixed Advantage. This is August will be our 35th year. So 35 years really is the flagship product in this asset-based LTC space, and really the option that all other carriers compare their LTC option against. Last year, we finished the year with the #1 market share again. And what we did coming into this year is we really put the pedal down and did pricing improvements here just in January. So we'll focus today on MoneyGuard Fixed Advantage. You're going to see those pricing improvements that we did here in January, anywhere between 0 and 14%, with an average discount, pricing discount of about 6% pricing improvement. So on top of already competitive product, we're that much more competitive. And Ryan talked about it, and my friends at Jetter know. I mean, the LTC story. This is leverage, legacy, liquidity when it comes to these asset-based LTC options, and really, it's changed quite a bit. I mean, folks, when I started in this business 20 years ago, we talked about what was the average cost of a nursing home. Where today we generally focus on what if the goal is to stay at home as long as possible, maybe go into assisted living. That's the trend. In fact, here at Lincoln, only 7% of our claims were paid to a nursing home last year. About 45% were home care agencies, 45% were assisted living. The balance, if you were doing the math, were adult daycare, hospice care type claims. But really, this space has transitioned now. Like, how do we provide tax-free dollars to allow my loved ones to stay at home and maybe move into an assisted living facility down the road? What we've also done this past year is taken really what has been our flagship product, Fixed Advantage, or if you're familiar with MoneyGuard 3 or MoneyGuard 2, and enhanced it. Most of you know, if you're familiar with MoneyGuard, we're the only carrier out there with no elimination period. What does that mean? When you get to the point for finally needing this LTC policy 10, 20, 30 years down the road, once you qualify for benefits, there is no 90-day or 60-day out-of-pocket additional cost. So that's critical. If we're providing benefits day one, what we also want to do is give that beneficiary more options on what to do with those dollars. So if I have a husband and wife, and John and Susie, they bought MoneyGuard 20 years down the road, John passes away in his sleep, he never needed long-term care benefits, okay? Up until this point with these types of solutions, and these are individual policies really that allow for customization. If he died, her only option as the beneficiary would be to take the death benefit. Lincoln has now introduced the option, and this benefit transfer rider, I know it's called rider, but it's built into all MoneyGuard policies. You won't even see it on the application. Is we wanted to give that surviving spouse or other beneficiary the option of what to do with that death benefit. Now, everyone that has MoneyGuard Fixed Advantage or buys a MoneyGuard Fixed Advantage now has 3 options. So that beneficiary can still have the option, if they want, to take that full death benefit. If they want to take that death benefit, he or she needs it, they can do that. But they're also going to have the opportunity to take that death benefit. If they don't need it, say they're 85, they're wishing, hey, I wish I had more long-term care at this point, we'll give them the opportunity to take that death benefit and roll it back into their own policy and enhance their own benefits. Or they could do a third option and do a little of both. They could say, you know what, my spouse passed away, there was a $100,000 death benefit. I could use 50,000 or 40,000 or whatever that number is today, but I'd like more long-term care benefits. So I could do a little of both. What's nice is these three options that you're going to see here for that beneficiary, they don't need to decide what they're going to do today. They decide at the passing of that other individual. At that point, they can decide what they want to do. What does it do for their own policy? When we talk about enhancing their policy, it increases their own long-term care benefits. It increases their death benefit, and it increases their length of protection. So maybe they bought a 6-year benefit period. Now they might have a 7.5 or 8 year, or they bought a 4-year. Now they might have a 5 or 6. So they have that opportunity. Here's what's really the real sizzle is to me is that there's no additional underwriting, meaning that surviving spouse, let's say John passed away, Susie says, you know what, I want to take a portion of that death benefit, roll it back into mine. She might already be on insurable. He could already be on claim with Lincoln Money Guard. She might have Alzheimer's and be in a nursing home. And we're going to give her the opportunity to get more long-term care benefits. Like I mentioned before, we don't require them to make this decision at the time of policy purchase. And if we roll that into, say, Susie's policy, and most folks elect to have a 3 or 5% compound inflation rider on there, when we roll those into her own policy, now her new bigger pool compounds. So it's really like, hey, we're going to add it into Susie's policy. Now her benefit will also grow. And I'll show you an example of that here. So in this example, you're going to see John passed away at age 85. Susie says, you know what? I didn't buy this for the death benefit. I bought it for the purpose of long-term care planning. So I'm going to take this $100,000 death benefit, roll it back into my policy. What is this going to do? One, it's going to increase her surrender value. So most folks, when they buy MoneyGuard, choose the 70% return premium option. There's a 100% option as well. But now her surrender value is going to go from 70 to 158. We're going to also leverage that $100,000 death benefit. So it's not just a dollar for dollar. You're going to see her death benefit goes from 100,000 to 208,000. So we leveraged about 8% for her on that 100,000. Now she's got essentially a second to die $208,000 death benefit. What we also have done is we've leveraged that 100,000 for long-term care. And again, this is the reason we bought it. But you can see at age 84, they've been compounding by 3% every year, 477, 491, 506, 521. Now we're taking that 100,000, and at age 85, they jump from 521 to 690. We've leveraged that over 50% for her. So we took that 100,000, we gave her she went from 521 to 690. Now the 690s compound. So you can see from 84, she had 521,000. Now 2 years later, she has almost $190,000 more in long-term care benefits at no additional cost. She's not lost out on the death benefit. We've just added it to hers. And her monthly benefit continues to compound like it always has. What did this mean for her? We gave her 30% more in LTC benefits. We extended her duration by 18 months. We added 108,000 to her death benefit. So instead of leaving it as is, as she had not transferred in, she would have had 537,000 or 72 months. Now she has a 90-month benefit period, especially as a widow. She now has a longer benefit period, even though, and again, we're not asking to do more underwriting. And she went from 537 to 690. The other thing, if you haven't looked at Lincoln in a while, and I know there's more options than ever, but this is the other key reason that we have the market share we do, is there indemnity type policies and we have reimbursement type policies. Lincoln has moved to the point where we're kind of right in the middle. We now have the ability to reimbursement, but also give up to 50% of that monthly benefit in cash. In fact, you could have we could reimburse you for a home care visit one day, and the next day if a spouse or child provided care, they could also get a portion of that monthly benefit in cash. It's really flexible when it comes down to that, but this is also built into MoneyGuard Fixed Advantage now. So this is available, this cash feature is available in all states except California. So when we think about MoneyGuard, obviously the flagship product, if we provide more flexibility, no deductible, the ability to transfer benefits, and the ability to provide some informal care, we've taken a good product and just made it that much better. If we think about, hey, Rob, how do you even claim if my wife's taking care of me or my daughter? What's the process like? Once you've qualified for benefits, you've qualified either the 2 out of 6 ADLs or been diagnosed with a severe cognitive impairment. This is what the form looks like. It's about as easy as it comes when we think about insurance products. If you've ever looked at an application, you write your policy number, your name, what year, what week, and how many days did somebody provide informal care for you, and that's the form to get a portion of your benefit in cash. So Brittany and her team are experts when it comes to all things long-term care across carrier partners. I think what we do really well. And then I want to turn it over to Brittany to open it up for questions.
Yes, thank you. And we do have a few questions. Looks like all three of us are going to get picked on a little bit. So Ryan,
Okay.
I'm going to start with you. Question came through. Can the owner of the business essentially pay themselves with an executive bonus as well?
Good question. So they certainly could. It just depends on, I would say, what's the most advantageous from a tax position for them to do. Would it be better to take a distribution, or just take extra wages? So the answer is yes. Might just be a little better if they did it a little different. But great question.
All right. Perfect. Well, thank you, Ryan. All right, Rob, you're next up to get picked on here. So looks like we have folks familiar with the Lincoln Financial MoneyGuard portfolio. Question coming through is if the new-ish, I guess, fixed advantage policy offers the residual death benefit like MoneyGuard 2 and 3 did.
It does. It's exactly the same. It's 5% of that specified amount. That is still there.
Perfect. Even better. Makes that policy great.
Yeah.
So I'm actually going to step in and steal a little bit of your thunder, Rob.
Okay.
So for those of you that are familiar with Lincoln or you're just getting to know them today, we've got some exciting news coming up. Not next Monday, the Monday after, March 13th, for clients 60 and younger in pretty much excellent, great health, applying for fixed advantage, they may actually see real-time approval. We're talking once that interview is completed, we could get an answer on the underwriting decision immediately. So, Rob, did you have any comments on that you'd like to include?
No, I'm really excited, and that really applies to both the folks that are electing to answer their health questions over the phone, or those folks answering their health questions via our e-interview. And again, that would be my plug. We now have the option to answer those health questions online at home with an e-interview. And I'll tell you, submit to place on average is about 10 days faster. And really, for my money, I would much rather answer a personal health question, take my time answering them online. That's now an option. For those of you that have done MoneyGuard in the past, and now that phone call, it lasts an hour, it lasts an hour and a half, it was in depth, it was exhausting. We're giving every single client the option to answer their health questions online. The only time they have to get on the phone with us now anymore is if they're 61 or older. It's just a 15-minute cognitive screen. So we're really trying to make it as easy as possible. And to your point, Brittany, hey, if we got those clients that are really, really healthy, and rather than have them wait, if we can just make a decision right then and let them know, that's the direction we're going. And hopefully this is really just the first step in implementing quicker changes, because we know if you have a quick turnaround, you're going to have happier clients, and ultimately for those of you advisors, agents, it get you paid faster. So we're excited about that change, and like Brittany said, that's coming in about a week and a half.
Exactly. And so those on the call that have worked and sold long-term care insurance over the years, this is unheard of. We've firsthand see this process with such a quick turnaround on a long-term care insurance case. So I know my new business team and case management team, they are loving Lincoln Financial right now and how much easier it is to do business. So that does wrap up our questions. So I want to thank everyone for joining us today. And of course, thank you, Ryan and Rob, for co-piloting with me. But if you think of questions after the call or would like to have a more one-on-one discussion, feel free to reach out to our team. Our number is 800-228-0008, or shoot us a quick email at ltci@jetter.com. So I hope everyone has a wonderful day and a good weekend. Thank you.